Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel, your most trusted voice in metals and mining. We have a great episode lined up for you today. I'm welcoming legendary investor, former CEO of Sprott US Holdings, and the founder of Rule Investment Media to the show. It's Rick Rule. We're going to get a number of his thoughts on several commodities, including uranium, gold, copper, a lot more. Rick, it's great to have you back on the show.
Pleasure to be with you. Thank you.
Yes, and we had some fantastic panels together at the Vancouver Resource Investment Conference back in January. There's one on uranium, which is on the VRIC channel here. I really recommend people check that out. There's another one we did on silver and gold with Maria Smirnova, and that is on my channel, Commodity Culture. Great conversation, so I'm expecting another great one today. I want to start, before we dive into commodities, specifically on Trump's tariffs on Canada, Mexico, and China now. Apparently, the latest news is he's pulling back the tariffs when it comes to Canadian and Mexican auto manufacturers. In particular, there's a lot of back and forth going on, threats kind of being implemented. It seems like either a misguided policy or he's playing 4D chess. I'm not really sure which one it is. I wonder what your thoughts are on these tariffs. How could they specifically impact Canada and Mexico in terms of their economies? And what about the commodities sector as well? Do you see any impact, positive or negative, on that side of things?
Well, being an American, I want to talk about how they might impact Americans first.
Yeah.
Tariffs are taxes, despite Mr. Trump's protestations to the contrary. I believe taxes are bad, all taxes. And so I believe that tariffs are bad. I also believe in a foreign policy that encourages many friends and few enemies. So I get you. I think you understand my drift. Politicians, for me, be they Trump or Trudeau, are to be endured. That's all. This is sound and fury. About 25 years ago, I read a very disturbing book. It was called The Art of the Deal. The author was a guy named Trump, and he talked about the fact that a transaction didn't have two winners, it only had one winner. And the idea was to make your opponent's life so miserable that he or she caved it to you. And I think that's what he's about at present. I don't believe that that's a good way to conduct foreign policy or economic policy. I'm an old-fashioned American. I believe in the Bill of Rights. And I believe that the best government, whichever T, Trump or Trudeau, heads it, is the one that is the furthest from me and leaves me alone the most. Obviously, this was a negotiating ploy. I know that either Mr. Trump or his advisors understand the interconnected nature of the North American economy, the fact that U.S. Auto fabrication plants rely on parts inputs from Canada and Mexico. This is no huge mystery. Uh, and everybody knows that Canada isn't blameless either. The shameless subsidies and the shameless protection for the Quebec dairy industry, as an example, comes to mind. It's just that Trump happens to be a more objectionable tyrant than Trudeau. I hope that makes my point of view clear.
Yes, absolutely. I want to talk about some other topics kind of related to the Trump administration, and that is gold revaluation and Fort Knox potentially becoming audited. These have been hot topics lately, even leaking into larger media platforms like the Joe Rogan podcast. Luke Gromen recently interviewed by Tucker Carlson, which I found very interesting. Gold is kind of getting out there, at least a little bit into the mainstream consciousness. I'd like your thoughts on both of those topics. Is it realistic to revalue gold reserves? And do you think we'll ever get an honest audit of Fort Knox?
Interesting question. I think we should have an honest audit of Fort Knox. That gold belongs to Americans. There are serious reservations about whether or not it's there, and if it's there, whether or not it's hypothecated, whether or not it's owed. Uh, at Sprott, we had a lot of gold audits. The technology exists to do that. It's not really complicated. One bar, two bar, three bar, sample the odd bar. It's not expensive either. And I think we need to call the question. The more the question isn't called, uh, the greater the destruction in confidence around the political economy in the U.S. And frankly, while that crisis of confidence might not all be a bad thing, I think that the government owes it to the American people to say this gold has been there for the last 50 years, but since there's a popular demand for an audit, we should audit it. Now, the Defense Department has failed their audits. There's been a lot of failed government audits. This one's a little simpler. You count bars and assay them. As I say, Sprata's been doing this for what, 15 years? But we'd be happy, I suspect. I shouldn't say we because I no longer work there anymore, but I suspect Whitney George would be happy to provide the technology for an audit for free to the US government. Now, revaluing the gold. I think that's a good idea, but it serves no purpose. If you revalue the gold, it makes the balance sheet look better, but in actuality, it isn't. There's $36 trillion in on-balance sheet liabilities, about $30 trillion net. If you revalue the gold, does the debt go away? No. Does it help you access more debt? No. Because who can foreclose? The US government owes me, let's say, if I buy some treasuries, the equivalent of 1,000 ounces of gold. So I'm going to pull up an armored truck to Fort Knox and demand payment when the counterparty has an army and nuclear weapons if I get nasty? I don't reckon. It's all theater. The issue isn't the value of the gold. The issue is the fact that we have $36 trillion in on-balance sheet liabilities and $100 trillion in the net present value of off-balance sheet liabilities. Little inconsequential things like Medicare, Medicaid, Social Security, military pensions, government pensions. When people quote the national debt, they quote that $36 trillion number, which is the small one. And revaluing the gold doesn't change any of that because no creditor and no pensioner has access to it.
Well, I'd like to touch on investing in the gold sector a little bit as well to follow up. Particularly, we've discussed this before on this show. We discussed it at the VRIC, the valuation gap between gold and the miners. I'm almost getting tired of bringing it up because it's such a topic of discussion that seems to persist to this day. We've discussed the majors and how much value you think there might be there in a company like Newmont and Barrick. I wonder if you have any thoughts going further down the chain into developers and the exploration space, if you see a lot of value there as well. We've obviously discussed the reasons for the valuation gap. In the past, there's been very poor management decisions made in the gold sector. So a lot of retail investors are hesitant to enter into that space. I'd imagine institutional investment is the same thing. So expand on your thoughts there for us and let us know where you're currently seeing value when it comes to the more mid-tier and smaller cap areas of the sector.
Well, I need to say I'm beginning to go down cap, uh, partly because 2, 3, 4 years ago, I filled my boots in the large cap. And frankly, they've done pretty well. Even the laggards like Newmont are up sort of 40%. But the real performers, the Wheaton Precious, the Agnico Eagle, the Lundin Golds, the Alamos, the people that performed, and mercifully I had the good fortune to identify those reasonably well, have done extremely well. And I don't think that they are aggressively priced. Agnico Eagle, as an example, now the world's most valuable gold company. If you look at the cash flow multiple and you look at the balance sheet and you look at the product pipeline, I would say it's fairly valued, but not overvalued. And I think you get any increase in the gold price absolutely positively for free. For free seems like a pretty good deal to me. Now, we are beginning to see fairly significant valuation gaps between large multi-asset producers and the smaller companies. Traditionally, this delta gets filled in either because the smaller companies increase in value or because the big companies take over the small companies. The recent takeover of Calibre by Equinox goes right straight to this. Larger companies have more trading liquidity. As a consequence, they have higher market caps and lower cost of capital. They get passive index buying. So there's a natural bias towards larger companies. If you do enough work so that you can identify the better targets, one of two good things happen. Either those companies' share prices go up or they get taken over. It's like the old Purelator auto filter commercial. You can pay me now or you can pay me later, which is a good circumstance. I also believe, as a consequence, in particular, of US government debt and deficits, that the gold price goes higher. I see the only way that we have of getting out from under our debt and our off-balance sheet obligations. I see the only political outcome as honoring the nominal value of those obligations, but inflating away the net present value. We did this, Jesse, before you were born, probably, in the 1970s. According to the Congressional Budget Office, the US dollar lost 75% of its purchasing power between 1970 and 1980. Not coincidentally, the gold price went from $35 an ounce to $850 an ounce. So at the same time that I think the big gold companies are reasonably priced and some of the smaller ones are cheap, I think the denominator goes up, which is to say, I think the gold price goes up too.
I wanted to pick your brain a little bit about exiting positions. I don't think this is a topic I've discussed specifically with you before. How do you personally evaluate whether it might be time to exit a position, whether you've taken a loss and you realize your original thesis proved incorrect, or whether you've made a gain and you think that perhaps leaving money on the table at this point could be too risky? How do you balance those two things when you're deciding to exit a position?
When I buy a stock, I always have a plan of why I bought it, what my thesis was. If that thesis turns out to be wrong, I sell the stock, irrespective of price. When my reason to own a stock goes away, the stock goes away. Win, lose, or draw. Goodbye. I have no fear of missing out. Uh, the second one, which is to say, if my thesis proved correct, is I believe every day you don't sell a stock, you rebought it. Any day that there's a bid and you don't take the bid, you rebought the stock in your own mind. Perhaps you could say X capital gains. Fine. So a winning position really has to do with, first of all, is the stock fully valued? And second of all, do I have a better use for the money? That's really simple. Warren Buffett once said that most investors should regard themselves as hog farmers, and their portfolio, their money is the trough. There's room at the trough for 10 hogs. If you're going to add a new, lean, hungry hog, you got to get rid of an old, fat hog. And that's sort of how I look at it. Do I have a better use of the money? If I have a better use of the money, I sell the old one, I bring on the new one. It's
That's a
much
great way to
easier if
look
I
at
made a
it.
mistake. If I made a mistake, I'm ruthless. I shoot it in the head.
Yeah, yeah. Great insights there. I want to talk about the uranium sector for a moment, where sentiment might be even lower than when we had our uranium panel at the VRIC. You mentioned an interesting comment where you said when some uranium investor or speculator on Twitter with uranium in his name goes out and on a limb and starts talking about the uranium thesis is dead, I'm throwing in the towel, that's kind of the time to buy. We're seeing this type of sentiment in spades, and yet the fundamentals of the uranium sector do not seem to warrant the type of sell-off we've seen in the equities. What are your current thoughts at present? Can we go much lower than here? Do you really care? And another issue that a lot of investors complain about is the time frame. They say, well, this was supposed to play out in 3, 4, 5 years from when I got into the sector, and I haven't made much money. And so how do you look at the time frame? Is it a matter of it just takes longer to play out than most people expect? And for those who have a long-term mindset, you can wait for the thesis to play out regardless of how long it takes? What are your thoughts there?
Yeah, I used to give a speech years ago, which I probably need to begin to give again, called The Difference Between Inevitable and Imminent. I prefer investment thesis when the outcome depends on when, not if. In other words, something has to happen, but you're not sure when. Most speculation involves if, not when. And I believe that uranium is when, not if. It is true that I believed that the stated pace of Japanese restarts would be quicker than the actual pace of Japanese restarts has been. And so the drawdowns on inventory held for sale haven't been as rapid as I would have preferred. Given that when you see volume in the spot market, very often the offerer is Itochu, a big Japanese trading firm. It tells me that some of the inventory that I thought would be utilized for refueling restarted Japanese reactors is finding its way on the market. It's also worthy to note, and by the way, most investors don't care about any of this. They just want a stock to go up without thinking. They want to wake up in the morning and feel good about stuff. They don't really too interested in why, which is why most people lose money. Um, but the spot market is an increasing irrelevancy, except in investors' minds. On many days, the trading volume of the Sprott Physical Uranium Trust exceeds the dollar volume in the spot market, which is to say, increasingly, the spot market is the spot market. And the action in terms of company valuation is taking place in the term market. The problem with all of that is just very boring. Investors don't want to have to understand the term market. They don't actually even want to have to understand the spot market. They just want the price to go up. And amusingly, they think that what they want matters, which it doesn't. You Companies go up over time because their value increases. And their value increases because they generate margin on their product. The beauty of the uranium business is the term contract, where, and it's the only commodity in the world that has this, you can lock in price and volume with an investment grade counterparty. And you can lock it in for 10 years, 15 years, 20 years. There is certainty in the term market. The term market is opaque. Companies aren't required to publish terms right now. And so it's difficult for people, except for people who can operate backwards, analyzing, as an example, Cameco's sales to reconstruct their terms. And most investors don't want to do that. They don't want to be bothered. Those people, frankly, Jesse, are my normal and natural victims. Uh, People who want to believe in the tooth fairy, and people who want to believe that their preferences are important, by their very nature, will sell undervalued assets and buy overvalued assets. I have to say, my re-entry into the uranium market uh, was not unlike some other re-entries. I came back too early. Uh, I think it was Bernard Baruch once, the great trader, who said the only guy who was ever able to call absolute bottoms and absolute tops was a liar. Didn't happen.
Do you think part of the issue with the uranium market for retail investors is this opaqueness when it comes to price reporting? I mean, the spot price is an incredibly thinly traded market of not much consequence to the real value of uranium, yet people track it like it's, the futures market in oil or gold or something like that. There is no real functioning futures market to speak of, and these term contracts or often have NDAs attached to them. People can't exactly, unless, like you said, they reconstruct sales and try to figure out the term prices. Sometimes companies announce at NextGen announcing the floors and ceilings for their upcoming contracts with utilities. I think that's out in 28, 29. Is that a big part of the issue for your average retail investor because it's so hard to wrap yourselves around such an opaque pricing market? And what's the best way for someone to perhaps overcome that and truly understand the value in uranium?
I'm sorry to say that the average retail investor doesn't know what the term market is.
Right. Yes.
And if there was a term market, he or she would be highly unlikely to read the notes in the financials. And if they did, they would be highly unlikely to get out a calculator and do a net present value calculation on the curve. So let's get that out of the way. Okay. Uh, there are a few of us who care desperately. For myself, either as an equity owner or as a potential lender in a construction contract. Over time, when I say over time, 5, 6, or 7 years, the companies that are forthcoming with the contents in their term contracts will enjoy a lower cost of capital, both debt and equity. This isn't anything that the government's going to cause to occur. It's something that the market is going to cause to occur. It's odd that in my 70s, I have enough patience to think in 5-year terms. Odder still, perhaps, that people in their 20s who have much more time left on Earth than I think in 2 or 3 month time frames.
Interesting thoughts. I want to discuss the copper market because a lot of the demand projections we've seen for copper moving forward are centered around the vision for a new green economy. So there are some people that call into question those projections and how feasible they might actually be. So, firstly, how do you currently view the setup for copper? Are you bullish? And secondly, if we completely remove the green energy demands, would you still be bullish if you are already?
Yes, I'm bullish, and yes, I would be bullish. In the West, we think about green energy because that's how we live. Uh, Many people don't realize that there's a billion people on Earth, Jesse, who still don't have access to electricity. One of the great unsung successes of our species is that in the last 40 years, we've removed 2 billion people from dire poverty and made them just merely very poor. There's a lot more work to be done, and I think it gets done over the next 25 years. Those billion people that will become electrified will be indirect users of a lot of copper. It takes copper to build power generation stations, irrespective of what how they do it, whether it's coal, whether it's sun, whether it's nuclear, it takes copper. It takes more copper to get it from the generating plant to the home. Once you get into the home, in order to use it, you have to use copper. You and I might think of Teslas because we see them on the street. The Tesla is of no consequence in Malawi or Borneo. The commodity boom that I enjoyed in the period 2000 to 2010 was all about the urbanization of China. It was all about moving 500 million people from rural penury to modern consumer society. And that's happening around the world as we speak. Even China has 150 million people left to urbanize. But if you look at the number in places like India and Indonesia, in Bolivia, there's a vast number of people. That's what copper's about. Now, in the near term, it's been a very long time since we had a synchronized global recession or depression. I'm not an economist, but if we did, then the copper price has a problem for a while. The inescapable solution, sadly, is that for 30 years we've underinvested in copper exploration, underinvested in copper development, underinvested in construction. And almost no matter what we do, we're going to have supply shortfalls over the next 5 years. If a supply shortfall coincides with a demand shortfall from a recession, the price doesn't need to go anywhere. But there's zero doubt in my mind that the gap between production and normalized consumption is going to be fairly large. The other thing that we need to realize, and this doesn't necessarily impact profitability, but it does impact supply, is the increasing social cost and social rent around copper. Government royalties, carried interests, taxes, payroll taxes, off concession obligations, and of course, regulation. There's a wonderful copper deposit, Jesse, in the United States, allegedly, a tier one political jurisdiction. You'll notice my laugh. This deposit is in Arizona. It's surrounded by copper mines. It's on a highway. There's water, there's power, there's community where people live that mine copper, so good labor. And it's a great deposit, over 1 billion tons, 1.5%, so 3 times the average mine grade worldwide. This thing, resolution, has been stuck in permitting for 26 years. 26 years. This is in a place that allegedly has no political risk. So yeah, I'm bullish copper, perhaps not for all the right reasons, but certainly a copper discovery in a jurisdiction that's actually favorable for mining uh, is a very good thing.
I want to talk about lithium for a moment. This is a commodity that kind of had its moment in the sun and now is seemingly getting left behind. A lot of people very bearish on the whole EV industry. I was recently in Croatia with Johnny Kovacevic. We recorded this 3 hour long podcast with which will be on my channel, Commodity Culture. And we discussed kind of his vision for energy and where he sees it headed. And he had some very interesting takes on EVs because he's not ideologically driven at all. He didn't mention climate change. He doesn't care about that. He cares about making money. And his thing is look to China. That's where he's pointing. According to his data, China has now surpassed, like they're selling more EVs than they are internal combustion engine vehicles at this point in time. The cost of these vehicles to produce and to purchase is extraordinarily low. And he believes that that will kind of change the zeitgeist. And eventually, over the years, the Chinese technology will spread throughout the world. Obviously, we have political barriers to that, but let's say looking out 10 years, and eventually EVs will be cheaper to drive than internal combustion engines. And thus, over the long run, lithium is a no brainer. I wonder what your thoughts are there.
A few thoughts. First of all, by pointing to China, he is ideologically driven because the Chinese system exists on subsidies at every level, at the consumer level, at the generation level, at the distribution level. So by acting as though the playing field were level, Gianni's ideologically driven. So let's get that out of the way. I do believe that Chinese manufacturing technology around electric vehicles will make them the dominant producer of electric vehicles worldwide because of massive state support, among other things. I think it'll be very difficult for them to really crack the US market because the US is so incredibly protectionist. There's a wonderful internal combustion vehicle out there called the Toyota Hilux that would change the nature of the US pickup truck business. The United Auto Workers and both Democrats and Republicans that would like to win states like Michigan, Illinois, Ohio, Pennsylvania will not let the $12,000 Toyota Hilux disrupt the $50,000 US pickup truck market. And if Gianni thinks that for some reason the United States is going to be more forthcoming towards a Chinese $15,000 EV than they have been for 40 years with the Toyota Hilux, he needs to change. So let's get back to lithium. What I'm starting to like about lithium is it's so hated. No, it's not hated. It's disappointed people. They're bored by it. But you don't see the hatred around lithium that you saw around uranium when it was at $18 a pound, or that you saw around the silver stocks 2 years ago. You don't see uh, you don't see that widespread hate. We raised a lot of money around lithium when we didn't have a lithium shortage. The price of lithium went up fivefold when SQM said in their annual report that at current rates of production, they had 85 years of reserves left. What we had was a shortfall in processing capacity, and that shortfall's gone. Meanwhile, we went out to look for lithium, and because we'd never looked for it before, and we devoted billions of dollars to it, we found a lot. I mean, we found a lot. And concurrent with that, we have new technologies like direct lithium extraction. If direct lithium extraction works on low concentration brines, like those produced by the oil and gas industry, I said if, not when, by the way, I'm no technologist. If that happens, the lithium game's over. You're competing with, very small, financially unsound companies like Berkshire Hathaway, ExxonMobil, Occidental Petroleum. So on the left-hand side, you got, some Vancouver Junior, Schlepp, Schmuck, and Schmo. And on the right-hand side, you got Exxon. If the technology's there, that's probably not a fair fight. If the technology isn't there, then you had 150 deposits which were discovered over 10 years, 8 or 10 of which are economic. And you have a speculator base that doesn't know the difference between the economic ones and the uneconomic ones. When lithium gets hated, if it does, to the extent that uranium was hated 5 or 6 years ago, I'll be in that space like white on rice. I'm compiling a shopping list now, but I'm not sure that this is a when. I'm more sure that this is an if. I don't understand the technology. And so I'm going to let the market explain the technology to me. If I see Exxon selling lithium carbonate, or if I see Mid-American Energy, Berkshire Hathaway selling lithium, I'm going to stay away for the rest of my life.
And is the oil and gas sector hated right now in your view? Obviously, very disappointing performance in the vast majority of equities. We continue to see headlines about how oil's going away. We recently had Trump's tariffs kind of cause a pretty big drop in at least the Canadian oil and gas equities, but many of the American ones too, over speculation this was going to disrupt the market. I mean, it seems like all the headlines we see are bearish for oil and gas. Is this a hated commodity in your view? What are your thoughts?
Uh, Not really hated, but I'm buying it anyway because it's cheap. It's hated beyond tariffs in the sense that what was that noted energy physicist's name? Greta Thunberg, whatever. She sort of set the narrative. And the big thinkers of the world, Biden, Merkel, Trudeau, those truly sage, wise political leaders, convinced the market, including some institutional investors, that peak oil demand would occur in 2030. The problem with that is it's untrue. Peak oil demand probably occurs in 2060, 2065. And so the net present value calculation that comes ending demand in 2030 gets stretched out 35 years. If you look at things like that, oil's very cheap. I'm not suggesting that the Canadian oil stocks can't get cheaper while the drama between Trump and Trudeau or Trump and Carnage um, continues. But the truth is that we have an integrated economy. Over some time, the next leader of Canada likely will understand that there actually is a business case for Canadian oil and gas, and that he or she probably should look at markets that are more reliable than the US. And Canadian oil and gas is cheap, 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 cheap. Doesn't mean it can't get cheaper, but it's cheap enough for me. One of the big mistakes that I've made this decade was in the COVID area. I think it was 2021 when Exxon got kicked out of the Dow 30. So two things happened. In COVID, the oil price went briefly sub-zero. It fell from $80 before it sort of settled out at 20 before resuming. And Exxon got kicked out of the Dow 30. So you had all this index selling, and you had a zeitgeist in the market that suggested that oil was going the way of the dodo. And did I buy Exxon? No, I waited for it to get cheaper. The consequence of that is that I paid probably 20% too much. And the lesson there is that sometimes stuff is cheap enough. Can it go lower? Absolutely. Does it matter? Absolutely not.
Well, Rick, this has been a fantastic conversation. So many great insights shared. For those who want to hear more from you, tell us about Rule Investment Media and tell us about Battle Bank as well.
Great. Well, Rural Investment Media is my own attempt to share the knowledge I've gained from 50 years of resource investing and speculating. And the front end of that is that any of your listeners, Jesse, who like what I've had to say about resources and want to personalize it, can go to my website, Rural Investment Media. Once there, list your natural resource stocks, the ones you own, not the ones you're thinking about buying. I don't want a list of 200 companies, just the ones you own. And I'll rank them 1 to 10, one being best, 10 being worst. I'll do that for free, no obligation. Be a little patient. I'm just back from PDAC, so I'm probably 10 days behind in ranking, but it's absolutely free, absolutely no obligation. And Battle Bank, you can see my shirt. Uh, Battle Bank is a labor of love. We, many years ago, started a bank called EverBank, which we grew from zero to $28 billion in depositors, from no customers to 275,000 customers. We sold it, and we're doing it again. Any of your listeners, Jesse, who are unhappy with their current banking relationships, any investors who are interested in getting paid interest on their savings and checking account should check out battlebank.com. Also, investors in your stable, Jesse, who own physical gold and silver and want to establish a margin account, want to establish or have access to capital without having to sell their gold and silver, need to visit Battle Bank. One of our primary lending strategies will be to offer margin accounts on physical gold, silver, platinum, and palladium that are held in segregated accounts. Once again, ruleinvestmentmedia.com, battlebank.com.
Excellent. I will put links to both of those in the description below. Thank you so much, Rick. It's been a blast. Can't wait for our next conversation.
Always a pleasure, sir. I look forward to that conversation whenever it occurs. Thank you.